This video is brought to you by togetherbudget.com. When it comes to investing, setting clear goals is crucial. What do you want to achieve? Are you saving for a specific goal such as retirement or a down payment on a house? Or are you looking to grow your wealth over time? Understanding your investment objectives will help you determine the right mix of investments and risk tolerance. Your time horizon is also crucial in determining the right investment mix. If you have a long-term goal, such as retirement, you may be able to ride out market fluctuations and take on more risk. However, if you need the funds soon, it's best to stick with more conservative investments. Diversification is key to managing risk in your investments. By spreading your money across different asset classes, you can reduce your exposure to any one particular market or sector. Market indices such as the S&P 500 or Dow Jones Industrial Average track the performance of a group of stocks. They can give you an idea of how your investments are performing relative to the broader market. Basic trading strategies such as buying and holding or dollar cost averaging can help you navigate the stock market. These strategies involve regular purchases of a fixed amount of stocks over time to reduce volatility. Investment costs can eat into your returns. Management fees, trading commissions, and other expenses can add up quickly. It's essential to understand these costs when selecting investments. Other expenses such as maintenance fees, administrative fees, and transfer fees can also impact your returns. It's crucial to factor these costs into your investment decisions. Comparing fees and expenses across different investment options is essential. Look for low-cost index funds or ETFs, which often have lower fees than actively managed funds. Taxes can significantly impact your investment returns. Tax-efficient investing strategies involve making smart choices about where to invest and when to sell. Tax loss harvesting involves selling securities with losses to offset gains from other investments. This can help reduce taxes owed and increase your after-tax returns. Long-term investing can also help minimize taxes. As you hold on to investments for longer periods, the impact of short-term capital gains tax is reduced.